Okay, pillar 2 of this lesson is what is the right strategy to generate an excellent return? The question is, what is the goal? There are a lot of people that they invest for the long term. They're saying, well, I'm going to put some money in something and then 10 years from now I'm going to take it out. And it should be worth, maybe 5-6 times more than when I started. The question is, and the problem is there's no guarantees. There's no way you ever can put together a plan where you can guarantee the result over time. So there's a lot of risk. And so what is the strategy to allow or to provide you with call it a weekly or monthly income? How is that possible? I've been investing a long time, and my first attempts were way back in my career, and I'd get some extra income to save it for, let's say, the children's college. Is I invested in mutual funds, index funds. That's what I knew at that time. So I employed those mechanisms that were available where I could try to get a return. I also did, I'll call it, investing in some Minnesota tax-free bonds, okay, where basically, I could try to make 4 or 5% a year tax-free, because those were the vehicles that were being published. Those were the ones that were being said, this is what you should do, and this is, the path I went down. It was not until I discovered that there are other ways to generate a positive income or a positive return on a more short-time basis. And that's the key to the strategy that we put together. So the question is, what is the strategy to generate an income each month? Well, you need a mechanism where you can invest in something and have it generate a return. In most cases, people say, well, I'll invest in a stock and I'll invest in dividend or high-paying dividend stocks. They'll know that they're going to pay a dividend each quarter, and that is at least some return, and that's true. The average, for example, on the S&P 500 is about 3% a year. On the Dow 30 stocks, it might be 2.5% a year. That you're kind of given when you own those equities. But that is not enough to say that's income. It's been my experience that anytime I got a dividend on stocks that I owned and I was using to generate income, and my strategy is I call that a bonus. I did get a bonus sometimes because I got the dividend that they paid. So the question is, how do you accomplish this? The key is I discovered the opportunity that's called call options. Way back in my corporate days, I was on an airplane with an associate, and he was doing covered calls, but he was calculating with his calculator, looking at the Wall Street Journal, and I asked him, what are you doing? He says, I'm looking at how much I can earn from my NCR stock. And I asked, what do you mean? Yeah, he said, I'm going to generate a return. I own X amount of shares, and based on what the Wall Street Journal published that day, he says, well, I can make 50 cents a share going out 1 month. And I says, how are you doing that? He says, well, I'm selling a call option. So after finding that out, I spent a lot of time researching the whole area of the subject and decided, this is something that makes a lot of sense. So I started, I'll call it doing the math on the opportunity of buying something and selling a call and determining what is the percent return. What kind of decisions can I make to improve that return over time? And it turns out that there are mechanisms or ways to look at options in many different ways, and that the fact that there are other option combinations, because there's not only a call option, there is a put option. So I discovered that putting together a set of combinations of both call and put options allowed me to put together a strategy where I can generate a significant return. And it can be as high as 2% a week with the right equity, with the right timing with what's happening in the marketplace. Even if you only did 1% a week, that is significant. Even 0.5% a week is 25% a year. There aren't a lot of areas where you can get that type of return. I know you can be lucky and buy a lottery ticket and turn $1 or $2 into mega millions, but that doesn't happen very often. So I don't suggest go and invest in lottery tickets. The probability you're going to win is going to be so small that you're just going to throw all your money away. You have to have a more, I'll call it, opportunity to calculate your result. And this is the one thing that I discovered with options is you can determine exactly what your return is going to be over time based on the decision you're going to make. So that's the strategy that I basically have developed, I'll call it improved on, and put together for myself way back, and now offering it as an opportunity for anyone else that wants to take the time to understand the opportunity and have them, I'll call it the mindset to go forward and actually do it. So the key is what is that strategy? How does it work? Well, let's take those one at a time. I talked about options. There are two types of options. There's a call option and there's a put option. And what is an option? Well, really an option is a contract that you write with someone that gives them some kind of benefit. So think of it that way. I mean, people sometimes take an option on real estate. They say, well, if I put some money down, if I give you X amount of dollars now, will you sell me that property a year from now for this price? Because he wants to hold the price at a fixed number. He's willing to give you something today, guaranteeing that he can buy that property a year from now at a certain price. So what is the risk? Well, the risk is the property may go up in value, and now you got to sell it at the price that you agreed on. Or the property could go down in value, and now the person that owns that option is surely not going to execute it because the market value has gone down on the property. Why would he execute the option? So he's just trying to put some numbers in place for him to make a decision today and act on it down the road. Same thing with equity options, calls and puts. So what is a call on the option side? A call option is something that gives the owner, the person that buys the option, the person that we're going to sell the option to, it gives them the opportunity and the right to buy the stock at a certain price in a certain time frame. And for that, he's going to give us a premium. He's going to pay us something, okay, because we're selling him that option. We're selling him the right. And an easy example is, take GE. GE is maybe trading at $30 a share. We say, okay, I will give you the option to buy my GE stock at 32 2 months from now, as long as you give me $1 today. You say, wow, okay, I get $1 today, I own GE, and I'm willing to sell it at 32. Why would someone do that? Well, but someone that's going to buy this option thinks that GE is going to go above 32. In other words, they've got the feeling that GE is going to move up, and therefore they're going to jump on this option to buy it today, give me the $1, so they can buy GE at 32 2 months from now. Because if it's at 35, they got a chance of making $3 a share by buying it at that time, but they're going to have to subtract the $1 they gave me early, so then made $2 a share. So it is I'll call it an opportunity for someone to say, I'm going to risk some money, I'm going to buy your option, and they're taking the risk of, to make money, the stock has to go up. What is the risk we're taking? Well, we're not taking any real risk at all. If we already own GE, the risk is in owning it. And if we don't own it and say, let's buy it, and if that $30 at the market, we can buy GE, and we've taken on the risk of owning, stock ownership. That's where the risk is. But we're going to get $1 for the option. So now I've in fact reduced my risk by $1. It went from 30 to 29. Okay, so I've already have some downside protection. And if the stock does go up, between now and 2 months from now, fine. I'm willing to sell my stock at 30. That was the decision. Okay? That's what I'm willing to do today. I'm willing to give my stock for a certain price as long as you pay me today for that opportunity. So you can see now, you can then very quickly look at what is your return over what period of time. So the key is now you're in control of how you want to say offer your equity at a certain price based on the option premiums that are available in the marketplace. And you might say, well, is there a real market? Trust me, the option market has doubled and tripled in the last 5 years because of the opportunity that it's presenting a lot of investors. So I've never experienced an issue that I couldn't sell an option on something that I own. The market is very liquid, and the companies and equities that that the system is generating for us have the volume requirements to allow you to execute the strategy very quickly. So this is not a thing that, well, maybe I'll be able to sell it. It's kind of how fast can you type on the keyboard, because you'll get filled almost immediately. So the key is that the option market has grown significantly, and the opportunities that it presents has broadened. There are options now on a weekly basis. When I started out, there were options every 3 months. So the industry has brought in a set of product and capability that allow you to make decisions on a weekly basis. And the other thing is they are offering options at strike prices on a dollar increment. Used to be $2 or $5 increments. And it's all based on the fact that most of it's being done by computers. Computers can crunch a lot of data. This is not some analyst that sitting on the market floor saying, I'm going to buy or sell a particular option. The options market is, I would say, 99.9% computerized. Okay, it's not just like the New York Stock Exchange has changed significantly. If you watch any of the programs on TV where they show the exchange floor, there are very, very few people there. If you back up 10 years or 15 years, there were many people on the floor actually trading the stocks. That has gone by the wayside. Stocks are traded by computers. It's all basically automated keyboards and people just putting in orders. They're really not negotiating with the guy who wants to sell. They're placing orders. The computers are doing all the negotiation of what to buy it at or what to sell it at. So that's where it's all being done. So the opportunity at this point in time is significant in the sense that things are computerized, the market is very liquid, the opportunity is basically putting together the strategy where you agree to say 1% a week or 0.5% a week is sufficient or is acceptable to you. That's the kind of decisions you're making. And that's the key. What are you satisfied with? The more assets you have, you probably say, I don't need to get 2% a week. 1% a week is sufficient. It reduces your risk. It gives you maybe a more comfort factor. If you have less assets, then you might have to add a little more risk, or you might even go on margin, which we'll talk about down the road. So the key is, on the call option side, it's the opportunity to generate a return on an equity that you own by selling the option for that person to acquire your stock for a certain price at a certain period of time. So that's the call side. Now what about this put? What is a put option? Well, very simple, answer is the put represents the fact that if you sell a put, the person that bought it can put the stock to you at a certain price, right? So that's why it's called a put. You agree to buy the stock at a certain price. So you sell a put option. So what does that mean? Well, let's take our GE example. It's trading at 30. Let's say I'm willing to buy it at 28 a month from now. So I can sell a put option saying, okay, I'll buy it at 28 if you pay me $1 today. Say, oh, really? Okay. you're gonna buy the stock no matter what the market is, and in that case, the market would have to be the stock would have to be at 28 or lower, because why would someone put you to stock at 28 if the market price is 30? They'll go and sell it at 30. So the key is, if I sell a put option, I am willing to buy the stock at whatever that option price is over that period of time. And say we go out a month, I get the dollar immediately. So now all I'm committed to is buying the stock at 28. And say it's trading at 30. So what is the risk? Well, the risk is I might buy GE at a lower price. If I'm willing to pay 30 for it today, I'm willing to buy it at 28 a month from now, right? So the key is you're making the decision based on real facts, information, and numbers. So the key is I'm going to get $1 for that opportunity. In other words, I'm selling the put, I get the dollar, and all I'm now do is, only thing I have left to do is I have to buy the stock if it's trading at 28 or below a month from now. And that's the only condition. It's kind of all automatic. I don't have to make another decision other than being able to buy the stock, and I made that decision up front. I'm willing to buy more GE at 28. So you can see now the opportunity of a put and a call. Now what if we did both? What if we did them together? And this is what I've developed over time. I'll call it a strategy. I call it a double up. So rather than buying, let's say, $50,000 worth of GE up front, okay, why don't I just commit $25,000 to GE? Buy some GE now and sell a call. So the example here we had is, I bought it at 30, I sold a 32 call going out a month. Okay, I got paid for that. But why don't I now take the other $25,000, hold it aside and say I'm willing to buy more GE at 28 by selling a put option at 28. So maybe in this case, I got $2 for the call, I can get $1 for the put. Okay, so I didn't commit all my money up front. I'm willing to buy some later at a lower price, which is a discount. And what happens, the stock has to go down before I'm going to buy more at 28. So now I've kind of given myself a channel for the stock to trade in, right? It's at 30, and the channel I've developed is 28 to 32. So if the stock kind of trades in that channel now for the next month, okay, I've basically almost got a home run. I got paid $3 for my strategy, and at the end of 30 days, I may still own GE, but I already made $3 on it, okay? At a $30 stock, what is that? That's 1%, right? Okay, $3, that's 10%. I made 10%, okay, by investing $25,000 in GE and planning to invest another $25,000 if I get assigned at 28. So I basically am in a position now where I'm basically in control of how much I'm going to get out of GE. Okay, and if things go the way I think they should go, based on the data that we're using, is GE is going to stay around between 28 and 32. That's the plan. Okay, it'd be nice if it goes up to 32. That means I get my money back. I get called out at 32, which is another $2 a share than what I bought it at. That's potential upside. I can't take that to the bank until it happens. But I can take my call premium to the bank, I can take my put premium to the bank, and I know between now and when that expiration day is, which is, we said 30 days out, okay, I've got $3 in my hand. Okay, that's mine to keep now. And I may end up still owning GE, I may end up selling GE, okay, at 30, or I may end up buying more GE at 28. Those are kind of the, the different things that can happen basically on expiration day. Now, how do you know that this is going to be successful? Well, I don't know that it's going to be successful other than what the system has told me to do at the time that we put this trade on. And this is going to be another set of, call it, in the lessons of the what and the when. The system goes through this process of determining what to buy and when to buy, and those are very key factors in the success rate. Because right now, over 95% of the time, my strategy is executing to completion. In other words, our example, the GE is at 32, I get called out at 32, and my put expires. That's 100% success. So that is kind of what the goal is to have the call get assigned and the put expired every week or every month. And if we're successful at doing that, we're going to generate this 1 to 2% a week. Well, the win rate's 95%. So that is significant. You think about what we're accomplishing, okay? Because at that win rate, there are very few times when the actual put is assigned, okay? And that allows us to do a number of other things. I talked about margin earlier. If you're able to open up a margin account, we have found that you can do most of your puts on margin. In other words, because the expiration rate is, in other words, 85% of the time our put expires because the stock price is trading above the put at the time of expiration. And that is kind of a goal, okay? Have the call assigned and the put expire. And that generates success. So if we're able to develop this channel, this trading channel for every stock, and it's different for every stock, the percentages are different. This is one of the pieces of the information and what's behind the strategy for the data that's being presented, is to basically mathematically determine what is this trading channel that a stock is trading in now and going to trade in the future. We're kind of always trying to look forward based on what's happened in the past. Taking that information and saying, this is where we think the system thinks the stock is going to be trading 1 week from now, 2 weeks from now, 3 weeks from now. So it's based on calculations, it's based on probability, it's based on what's happening with that stock in the marketplace. So that's a big piece of the strategy of generating an income on a continuous basis, whether it's weekly or monthly, is being able to get the data, apply the data to the trade successfully. And once you get into that mode, it becomes very straightforward of picking the right equities and putting on the correct trades. So that is key to success for generating income on